Hey traders, this is Blake Morrow with Traders Summit, and it's Friday, and it's at the end of a very, very wickedly wild week for the markets. And so, of course, I'm going to bring in Mr. Jim Welsh from Macro Tides and bring him on the program because we talk every Friday pretty much without fail.
Yeah.
Jim, what a week, right? I mean, I'm literally worn out. How about you?
Well, it's been a crazy week. At the same time, we have to acknowledge that spring has sprung, which is why I'm wearing this yellow shirt. Is kind of like springish.
You do look little like an Easter egg. I'm not gonna lie. I know you're playing dress. You're a week early for your grandkids, but
Yeah, yeah. There's no time like now, you know?
that's right.
Uh,
No, you look
no,
very springy.
yes, well, good. We mission accomplished. No, it was obviously a week driven primarily, obviously, by the FOMC. I thought that we would see a larger move in the dot plot than we did, that we would see it go from 3 to 2 dots. And we're going to talk about it. It kind of went from 3 to almost 2.5. But markets were maybe somewhat apprehensive that that was going to happen. And when it didn't, it was, oh, all right. Also, Powell was asked about the uptick in inflation in January and February. He acknowledged it, but kind of said, well, we're not going to dismiss it, but we're not going to overweight it. So that provided some comfort, I think, to the markets as well, is the idea that they're not waiting for every single tick. The other issue was confidence. He expressed the same thing he's been saying. We need to have greater confidence that inflation's going to 2% before any cuts would be warranted. And what we're going to talk about a little bit today is why the markets may still be a little too optimistic. I'm not sure in the near term, Blake, over the next month, that the Fed is going to get more data to provide that confidence.
Jim, this is kind of a situation that I've been talking to a few folks about this, and I'd love to hear your take. We're you think about the timing aspect of all of this. We've got 3 rate cuts priced in, but can't forget that at the beginning of the year we had 6 rate cuts
Six.
priced in. But the market's looking at 3 rate cuts, and we have
Right.
what six meetings left.
Yeah.
Obviously, next month. The expectations, is it May or April? I'm sorry.
No, I think it's May 1st or
It's May,
something.
yeah, it's like right at the beginning of May, right? And
Yeah.
the expectations of a rate cut are very, very slim.
Low.
Yeah,
Right.
very low. But then you get into election season, and I'm like, well, if the Fed wants to play the card like we're not political, but we're going to continue to cut, but would they look political? And is that a way to, oh no, we can make this into a political show, the way to help the
Yeah.
Biden
Yeah.
administration in a sense? I don't know. It just gets
Yeah.
really
Yeah. Yeah.
tricky from a timing perspective. What are
Yeah.
your thoughts before we move on to your
Well, I think the Fed would probably prefer to be apolitical. I mean, that's what they espouse. It's easier sometimes than others because we're heading into an election that's going to be very contentious. And there's people who are very anti-Biden, anti-Trump, or pro-Trump. The divisiveness is amazing. So they're willing to pounce on anything. So my point would be is I think for the most part, Powell and company are going to keep their eye on the ball. And if something is warranted, they will act. And that's what I think is going to take. So will they cut just because an election is coming and they favor Biden? I don't believe that. I mean, there's obviously people who do believe that the Fed's going to do whatever it can. But I'm not in that camp. I think these guys are really sincere about trying to get it right because of the bigger picture.
I agree with that too, but the risks are they will look political, and if the economy starts to slow as we head into the election, as it does seem like that could be the case, that there's a high
Yes.
probability, they start cutting, and then everybody's going to say it's political.
Those people are going to say whatever they're going to say no matter what. I mean, that's where we're at, unfortunately, is people on the left will make claims and statements that really are half-truths, and the people on the right do the same thing. It's like the idea of, a handshake and being, I gave you my word, that's all you need. Those days are long gone, unfortunately, I think. And so right now, everybody just wants to nitpick like crazy to score political points. So I think, Blake, no matter what the Fed does, somebody is going to be upset. If they don't cut rates, well, they're trying to help Trump. There's going to be people on the left that'll say that. If they do, you're going to have people on the right saying, oh, they're trying to get Biden in there. I just think the Fed is truly, from their perspective, the next 6 months or so are really critical in terms of succeeding, in terms of getting inflation down, having the confidence it's going to stay down once they, in fact, do cut rates so that inflation isn't rebounding next year. Because Powell said in a statement, and I'm going to paraphrase it. What they don't want to do is cut rates and then all of a sudden have to turn around and hike them. And I think that right now, in terms of the risks being balanced, that is almost true. But at the same time, that risk is a greater risk. And I think the Fed is attentive to it because they just raised their forecast by 50% for GDP. They were at 1.4 for 2024. They went to 2.1. So to me, that's the safety net from the Fed's point of view, while we can be patient and wait, because, hey, the economy continues to act pretty good, and we just need to see the inflation numbers come down, so we're really confident.
Jim, the Fed's never raised rates in a recession and had to cut them when inflation's going up. Just had to
that's the way it works, And we've talked about this often in terms of last year everybody was talking about a recession, and now I think it's like 1 in 6 people think there's going to be, in terms of economists, there's going to be a recession. As if all that tightening, the increase in lending standards isn't going to, have a dent. I continue to believe that is not true, that we will see a slowdown. It just comes down to, when is it going to really materially show up? And,
all right. Yeah, well, I mean, you've stuck by this a long time, and I always think in the back of my head, 19 months. When did those leading?
January 24. Right. So we're at that point in time where the greatest amount of pressure is coming to bear, and we've talked about this. And Powell referenced this, and of course he was ridiculed. He said financial conditions are still restrictive, and a lot of people, oh, he's out of his mind. Look at what the markets are doing. And my point has been, we've talked about this, there are two types of financial conditions. There's financial condition indicators that measure stock prices, Treasury yields, the dollar yield spreads between corporates and treasuries. Those have eased very, very significantly. They're back to almost where they were at the beginning of 2022. But the real world financial conditions, in terms of what are small businesses paying to get a loan, well, those haven't eased at all. Somebody wants to borrow money against the home equity in their home, maybe to do some fix-up work, all that. Those haven't come down at all, even though we saw mortgage rates drop by 120 basis points. So my point is, on Main Street, we do have tightened financial conditions. And that's what Powell was talking about. And a lot of other people were like, well, he's out of his mind. He's whistling past the graveside, that look at how easy things are. The fact that markets are doing what they're doing does suggest, in my mind, that they may not be tight enough.
Well, and that's to be seen, right? And then this,
yes,
yes. And that's why the higher for longer mantra, I don't think is dead yet. It's not dead, right?
Not at all.
Yeah.
And I think, again, why don't we get into some of the charts?
Let's do it. The first chart you brought, Jim, was the March SEP. Talk us through this chart, and let me go ahead and zoom on in here for you. What do we got?
Okay, so my point is, you look at the GDP. Well, that's a big increase. I mean, from 3 months ago to go up by 50%, 1.4 to 2.1, 0.7% is a big increase. And then for next year, it's not going to really slow much. Unemployment rate, well, they were at 4.1. Well, maybe now it's only going to be 4. So they're looking for everything to really stay incredibly steady. PCE inflation, okay, it's going to, the headline is going to, wasn't changed, but the core went up from 2.4 to 2.6. And so all this, in a sense, flies in the face of the idea we're still going to cut rates 3 times. All right. And so this is where, in a sense, Powell is saying, hey, we've seen this big drop in inflation. We think that inflation will work its way lower over the next 1.5 to 2 years if the economy grows at 2% without us having to do anything. And even if we lower rates this year, we still think inflation is going to be down next year. 2.2 on the headline, 2.2 on the core. So he's expressing a great deal of fact that what we've seen, the progress that has been made on inflation without the economy going into a recession, unemployment ticking higher, they're saying, well, it's gone on this long, it's going to keep going.
Yeah.
And, but the question is, are they really going to add stimulus or be able to add stimulus given those numbers?
Jim, I don't think you brought a chart regarding this. Correct me if I'm wrong, but you haven't talked much about Treasury purchases. Maybe we can go in, like, what they're going to do with their, with the QT program. Do you have any thoughts there, or maybe we can save that for a bit?
Yeah, we can say that only from a standpoint that what Powell is basically saying is if we cut back a little bit on the runoff of the balance sheet, which I think is like 65 billion of treasuries, if we trim that a little bit, if that should negate any potential liquidity issues that show up, like back in September of, was it 2019, where you had some disruptions that took place. And I think they're trying to say, okay, if we do this more gradually, we'll avoid a disruption that then would force us to stop purchases altogether. That's the logic,
Okay. All right.
And I don't have a problem with that. Do I think it's, hugely bullish? Not really. Because if there's going to be a problem, I think with commercial real estate, it's going to develop whether or not they're trimming how much they pair the Treasury holdings in their balance sheet.
Okay. All right. Well, thank you. The next chart we have, or that you brought, excuse me, is the dot plot. So tell us how to interpret this, because there's obviously a lot of discussion around the dot plots.
So the assumption, and that we didn't talk about, but that first chart, the Fed funds rate is still at 4.6. Okay. So despite stronger GDP, unemployment holding steady or dropping slightly, tick up in inflation in the next, the balance of this year, 4.6. That's what everybody focused on. That didn't change. So being the nut job that I am sometimes, I thought, I got to look at this. And so I went back to each of the dots in December and March, and then just said, okay, what did they all add up to? And what you can see is in December, it was 4.7%. And in March, it was 4.81. Not a big shift, but 11 basis points. And so the summary of economic projections, that 4.6%, is a median. So if you say you got 19 people that are casting a projection, so the median is going to be right smack dab in the middle. And look at what you can see is right around that 462, 487, there is a big grouping, subtle changes. In the December SE or the dot plots, you had 8 people at 487 and above. Well, in the most recent dot plot, you have 9 at 487. Subtle. The range was 150 basis points from the high to the low of the dots in December. It narrowed to 1%. In December, you had 5 people at 437 or below. And in March, there was 1. So under the surface, you saw some shifting going on where I think people are like, okay, the January and February inflation surprised us a bit, but we're not going to overreact, which was what Powell said in the press conference. Um, and we talked about the January CPI could be explained in part because of seasonal adjustments, some of the weather that took place in the month of January, so on and so forth. February didn't. The point we're going to look at next is, okay, this next week the PCE comes out for February. So we've talked about this. All this stuff is a rate of change. You take away the number from 12 months ago and you add the current number. So February of last year, 30 basis points off the headline PCE. And in January, it was up 30 basis points. If it does the same, headline CPI is going to hold steady at 2.4. The PCE might tick down a little bit because you're taking away 40 basis points from February of 23. And if it does the same as it did in January of 0.40, it treads water. So my point being is this data points may not, again, reinforce the idea of, gee, it's heading down toward our target. You're seeing some flatlining taking place. And if you go out into the future months, you can see you got 30 bips coming off in April, and then the next 2-3 months are really low takeaway values. So my point is over the next through June, you still may not see really through July, because in July it's 10 basis points from last year. It's possible that all these inflation metrics in terms of the PCE don't change a whole lot. In other words, not a lot of progress.
And the risk would be an incoming data coming in a little hot. Then next thing you know, you got to tick up in PCE.
They're ticking up a little bit.
Yeah.
Okay. So if we look at the next table, it's the CPI, and this is for March. So that'll come out on April 10th. The takeaway value from March of 23 is less than 0.1%, 8 basis points. Well, in January, it was up, February was up 44 bips. Oil prices and gasoline prices have gone up more. I think airfares are still pressing and so forth. So my point is, if it goes up 0.4 during this month, when it comes out on April 10th, well, you subtract 8 basis points and you add 40. All of a sudden, the headline CPI goes from 3.2, which I think they rounded it, up to 3.4. I think that's a little bit of a shocker. The core, because the takeaway is quite a bit bigger, 32 basis points, if it goes up like what it did in February, it's going to be a push. And the point I would make is, again, if you go past April, there's big takeaway values in April for the CPI, but the next 3 months are really pretty low takeaway. So to your point, Blake, if the month-to-month changes in 2024 hold at 0.2 to 0.3 approximately, we're going to see the inflation numbers not go down and maybe creep a little bit higher. So the point I'm trying to make here is Powell emphasized we need to have more confidence that inflation is working its way down. And potentially they're going to get status quo where the numbers kind of go flattish. And if, to your point, gee, what if the numbers, month to month are a little worse?
Right.
Well, all of a sudden now we're talking about a big surge, but the point being is they want to have confidence to cut. And they may not get it with the data on inflation. And all of a sudden, gee, in June, do they still forecast 3 cuts? Because we may not get that cut. Right now, I think it's around 70% probability of a cut.
And Jim, I gotta point out, I mean, crude oil has got its head above 80.
Yeah.
You look at copper's at $4, right?
Yeah.
I mean, you got commodities. Cocoa's gone cocoa for cuckoo puffs. I said that earlier this week for
up 250%.
Yeah, it's up craziness.
Yeah.
Commodities are really, caught a bid recently. It's hard to imagine, and then you got all the other geopolitical risks that are
Right.
clogging up, a movement of goods and services are going up, and it's costing more to ship stuff everywhere. Look, it's hard for me to see a deflationary environment. I know that might be the risk for China as they are developing. They're developing a lot of our goods or the world's goods. Their consumers buckling. I get it, and everybody wants to try to draw a parallel. Well, if China's seeing deflation, everybody else is going to see deflation, but they are the manufacturers predominantly globally.
Right.
They're one of the biggest
Right.
manufacturing hubs of the world. It that doesn't mean we're going to feel it. So, and
Right.
I think to
We're
your
much
point,
more a service economy
we are.
than China. I mean, goods make up less than 15% of GDP. So, for there to be real inflation relief in the next 6 months, because goods prices actually have ticked up a little bit. In other words, they were negative for much of the last 6 months. Now they're positive. It's not a big component, but yet, those were the things that fell. Energy prices last year declining significantly were the easy gains. Well, now they're reversing a little bit. So again, the Fed wants confidence. Everyone thinks just because he said it, they're going to get it. And what the data suggests is it may not come as quickly as markets are presupposing. And the idea that we know we're going to get the 3 cuts. No, I'm not sure. I'm not in that camp. When I look at the data points, I'm like, wait a second. When the March inflation data comes out, it's not going to be friendly. And so it's one thing, it's like data points, it's like, okay, one data point, well, we can it's just a blip. All right.
Yeah.
2, okay. 3 makes the mindset is it's a trend.
Right.
And
right,
so
exactly.
to me, that April 10th release of the CPI, I think could be pretty unsettling to markets because, again, if it jumps by 0.2% on the headline, and mind you, last June, it was down around 3%.
April 10th, should be marking it down.
Writing that down. Well, we'll probably talk about it.
All right.
before it
Well,
happens.
before we do, and we're going to talk
Yeah.
about the technicals that you brought, Jim, I just want to stop for a moment and say, if you guys appreciate Jim's macro, putting it all together for you, make sure you give him a big thumbs up, subscribe to the channel down below, comment down below if you have any comments and you think that Jim's off his rockers. He is, Jim, you're getting up there, man. Maybe you're losing it here. I don't think you are. But if somebody thinks that, jump down in the comments below and give Jim your thoughts. All right, let's go into the next chart that you brought, Jim. Some of the technicals here, because the dollar, I'm a little. I mean, post FOMC, the dollar slumped, then it just rallied back sharply, and then we're closing out near the highs of the week. How are you reading this?
Well, last week when we talked about it, I noted that, from that 104.97, you only had 3 waves down. And what that implied was if it pushed above 103.43, you'd have an overlap. And that opened the door that potentially the rally from 100.62 to 104.97 was wave A of a larger upward correction. In other words, you got 5 down from 107.34. And that potentially we had wave A, the 3 wave down was B, and we were about to go wave C that would take the dollar above 104.97. And potentially, if wave C is equal to wave A, which was up 4.35 points, you're talking 106.71. So
sorry,
it's interesting.
I drew a little too far there.
Well, that's all right. Just getting carried away. So yes, to me, this implies that the inflation data, we got some economic data that was a little better than expected. So together, the chart basically to me says the dollar looks like it's going to go higher. Longer term, does it change my view? No. That the dollar is going to drop below 100.62 in 2024. Near term, you got to respect that it's going to push a little bit higher over the next few weeks.
All right. Well, It sure does feel that way, and I think it's stunned a lot of traders who've been leaning into the dollar short, especially following the Fed. So,
Yep.
what does that mean for gold? Because gold rallied sharply on it
Yep.
was in Asia. Damn it, Asia.
Yeah.
Like low liquidity,
Yeah. Yeah. Yeah.
pop through the stop there or the highs.
High.
What are your
Yeah.
thoughts? It's still holding up
Well,
well.
yeah. We talked last week. It had been pulling back, and I had noted that to me it was wave four, and that we were going to get a pop above 2193, which obviously we did. I told subscribers that they should sell half their gold position if gold got above 2200, which what happened. And that
Wait a
five
second.
up
You do that with the macro tides, folks?
yeah,
Okay, just taking notes here. Good. As
yeah.
you should. And people should note that. All right, continue
They
on.
should note that. And so to me, Blake, that five up implies we're going to get a pullback. Well, gee whiz, we just covered the dollar. And that was one of the reasons why on Monday I'm like, you know what, got to sell into if when gold pops above 2193, because the dollar chart's starting to look like it's going to push. And that would, I think, be a headwind after this big move up in gold. Where can it get to? 50% retracement is right around 2100. It could it do a 618 and get down to where all that resistance at 2070. Very common for markets to break out and then go back, check the breakout before the next leg up. That's my expectation, is that we're going to see a pullback in gold, and then we're going to see another rally that takes it above 2300 this year.
All right. So you anticipate a slight pullback in gold. What's it mean for treasuries since the dollar's going up?
Yep. Well, I've the last couple of weeks, I've been talking about, I think treasury yields are going to go higher, that the 10-year and 30-year we're going to take out their highs, from February, which on the 30 was like 4.505. The way the pattern is evolving, it's doing what is called a double zigzag. ABC up, then an X wave down, and then I think another A. We've gotten this little pullback for B. I think we're going to see treasury yields pop above that 450. And the high this week was at 448 on the 30-year. Couple targets, 466, 468. That's just saying, hey, the first leg up was 50 basis points. The second leg up, make that 56 basis points. So I actually didn't calculate that correctly. A little bit higher. And then within the zigzag, the first leg went from 419 to 449, and you add, 30 bips to 4366, and you get 4666. So to me, I think we're going to see treasury yields pop higher. And that will, I believe, on TLT, I think the 618 was like 89.50. The 50% was maybe 91.50. So in other words, we had 5 down from last October. We are now getting a retracement move. And once this retracement move is over, my expectation is we're going to see another leg down in treasury yields. So on the 30-year, it dropped about 120 basis points.
Yeah.
So if it gets up to 460 or so, another decline of 120 basis points brings it down to about 440 or so. I believe the low in April was maybe 440.
Okay.
Pardon me, 340.
Which would be
So April of 23, I think the low was 340-ish.
Okay.
So in other words, just a big ABC to that low. And then I think treasury yields are going to begin a large increase after that. So again, to me, I'm focused on the idea that we are going to see signs of slowing materialize in the economy as we get closer to mid-year. And that's what's going to be behind the big rally. It might also get a little bit of an assist, because somewhere between now and mid-year, the Fed is going to announce we're scaling back our runoff of treasuries from 65 billion to, I'm going to make up a number, 40 billion.
Yeah.
Well, that'll be helpful in terms of, okay, we get auctions and, that's whatever they scale back is, less supply for the market to have to absorb and deal with.
And the stock market may like that. So tell us a little bit about the S&P here, because we
Okay.
are, grinding up in this ascending channel. I think I'm
Yes.
looking at the
So,
exact same channel myself. So
yeah, well, it's hard not to see.
right.
I mean,
Yeah.
rarely do you see channels that last this long. So, as we've noted last week, you got higher lows, higher highs, uptrend. All right. I think it looked to me like there was a small triangle that took place after the S&P hit 5189, A, B, C, D, E, and triangles show up in wave 4 of whether it's a 5-wave up move or 5-wave down move. They're followed by a thrust. Well, why? Well, you can see, you could draw a trend line from 5189 connecting those 3 peaks at B and D and the original high. You get above that, you hit stops. People, hey, we're breaking out, let's go. And the Fed, the news in terms of, hey, they're going to still give us the 3 rate cuts, as justification. From wave E, you can kind of see 1 up, a little down 2, the big pop for 3. The pullback so far today, I think, is 4. My guess is there's 1 more tick higher above 52.61. The triangle, you measure the width of the triangle and you add it to the breakout. The width of the triangle was 98 points. And you add that to the 5189, and that's where I get that number, 5287.
Something that looks like that. Right.
Okay. So I think we're approaching, we've got 2 legs equal now from October of 2022, from 3492 to 4607. I think it was 1,115 points added to 4104, and that's where you get the 5219. So we're at a point where you've got 3 legs up. You got a quality, and if you're bullish, okay, we're going to get a pullback for wave 4. Wave 2 took the S&P from 4,600 to 4,100. So wave 4 ought to be, somewhat comparable. So you're talking a move down under 4,900. And then if you're bullish, then we're going to get another push higher. Certainly possible. We're at a juncture, though, where the bearish count says, it just was a 3-wave big rally. And now we're ready to roll over, and we're going to get something more sinister than just a pullback of 400 to 500 points.
And you said sinister. I don't like hearing sinister on Friday. I want to go have a relax on the beach with not thinking sinister in the markets.
Sure. Well, no, my only point is we're at a juncture that even if I was bullish, I would longer term, okay, hey, man, we're going to the moon, Alice. Some people might remember that line.
I
do. You do?
Yeah, Lucy.
Go ahead.
Oh, no. Wait.
Jackie Gleason.
Yeah, that's
honeymooners.
To the honeymooners. To the
his
moon,
wife.
Alice? Yes.
You got it, man. So even if I'm a long-term bull that, hey, we're going much higher and all that happy stuff, after the 3 waves up, with the equality, you're still looking for a decent pullback. Wave 2, as I said, was 500 points.
Yeah.
4 doesn't have to be that deep, but I would assume 350. So we're talking about a move to, 4950, 4900.
Yeah.
Seems reasonable. And if it's a 3-wave decline that gets us down there, Blake, well, then it's like, okay, folks, we're going to higher highs. But if we see a 5-wave decline, if indeed the market ever does pull back here, that will tell us a lot in terms of, wait a second, we've got a much bigger decline coming. But to me, we're at a point where a pullback of some magnitude is very probable.
All right. Well, Jim, thank you every week for walking us through all the technicals and the markets just in general. Really appreciate you.
Thank you.
Tell us how traders can get a hold of your most recent technical report.
Send me an email, jimwelshmacro@gmail. Go to macrotides.com. There's additional information on the website that you can kind of review. And again, yeah, I love doing this, Blake. It's fun, and I think we're helping people.
Yeah, absolutely. And it
At least the
helps,
nice people are responding more often than not
yeah.
to the videos. So thank you, nice people.
Well, we appreciate you. And Jim, have a nice weekend and
The
enjoy the
same.
weather while we've got this beautiful weather, right?
Springtime, baby.
All right. Thanks, Jim. We'll see you next week.
You got it.
Hey traders, Blake Morrow here. Thanks for stopping by our YouTube channel. Don't forget to like, share, and subscribe to our channel. Also click the bell notifications so you do not miss any of our market-related trading analysis from some of the leading industry experts. Thanks for stopping by. We'll see you in the next video.